Well, hello everyone. Welcome to Trading Price Patterns. My name is Barbara Armstrong. I'm a coach with Schwab. And today we are going to talk about trading breakouts. And we're going to talk about recognizing, pennant patterns when they're happening, breakouts of pennant patterns, or breakouts of diagonal lines of resistance or horizontal lines of resistance, and retest. And then, it's one thing to recognize a price pattern. It's another thing to know what to do with it once you've recognized it and how a trader might trade it depending on their account size, their goals with their trading. Is the trader looking to grow their account? Are they looking to generate income? Are they looking maybe to protect positions? So all of that comes into account within the world of trading price patterns. We also last week placed 6 trades, or I'd like to think of it as 3 pairs of trades. So we placed 2 trades each on 3 different stocks, and we were going to compare and contrast those. So today we're going to continue with our comparing of trades and having a conversation around when we might use a short put vertical versus a long call vertical, for example, or a short put vertical with a near-term expiration versus a further dated out expiration, that kind of thing. So we're going to place some new trades, and then we're going to look at some of the pairs of trades we put on last week. So we have got a lot to cover today. I hope that you have got your sleeves rolled up as I do and you're ready to roll. We have the pleasure of having Kevin Horner with us in this class. He has taught this class in the recent past, because he covered for me while I was on my Barb 2.0 project. Hiatus, if you will, and did a fantastic job. So if you've got any questions, don't hesitate to ask. If you're not following Kevin Horner on X, you're missing out. Kevin Horner CS, Barb Armstrong CS, we're both posting content there on a daily basis. It's another way for us to communicate with you and you with us outside of webcasts like this. So take advantage of it. I'd encourage you to do that. Okay. So just before we get into the thick of things, and I'll be moving fairly quickly today, this is an intermediate level class. So, that's not unusual for us to cover a lot of ground in our 45 minutes together. But know that all the ground we cover is educational in purpose. None of it's to be construed as a recommendation on the part of Schwab or myself. Also know that we use the Paper Money software application on the Thinkorswim desktop platform. It's a brilliant place to become familiar with your trading strategies, familiar with the platform before you consider trading in your live account. There are some nuances and differences between Paper Money and a live account. The biggest one for us, and we're going to look at some verticals today, which include short legs, and a short strike can be called out early in Paper Money, but that will never happen. A short position can be called out in a live account. That will never happen in Paper Money. I think I said that backwards. So, but we get to discuss what can happen here in these webcasts, and we do. And this is a technical trading class in that it's about trading price patterns, which is based on looking at the charts, which is technical analysis, but other approaches, including fundamental analysis, being aware of what's happening globally with tariffs, with interest rates, like all of that stuff, let alone earnings season, which we're still in the throes of. All of these things help us make a more informed decision as well. Okay, so that's where we are. So today I've got one quick announcement. We're going to do not much of a market overview, because Kevin Horner and Brent Morris did a fantastic overview of what's going on in the markets this morning at the market open at 9:30 Eastern. That's available to watch in the archives. So if you want to get down and dirty with a great overview, please go watch that. It was great. We're going to play some new example trades, like I said, and do a little trade management. Now, next weekend, Ben Watson and Kevin Horner are going to be in Washington, D.C., and that is not on this slide because we're already full to the brim on that 2-day workshop. But we've got Dallas coming up September 20th, and I'll be at that one. Kevin, I'm not sure if you're going to Dallas as well. I think so. And then Chicago is the first Saturday in October in Schaumburg. We'd love to have you join us there. And these are top-down approaches. So we go from what's happening in the markets globally down to what's happening within our country. How are things like tariffs potentially influencing the markets, and we have a conversation about sectors, and we get right down to individual stocks, or like some example stocks, and how those might be traded in the context of all we've discussed all day long. We'll have the coffee on and provide breakfast and lunch, a beautiful reception at the end of the day, and it's all complimentary. It costs us a fortune to put these on, and you'll understand that when you come. We'll even pay for your parking. So Chris is saying that he'll see us in Grapevine. That's fantastic. It's a beautiful resort. So, and please, if you're a regular attendee of these webcasts, please come up and meet us. That's for me, one of the best parts is getting to meet all of you. So please come up and introduce yourselves. Okay, so here's the NASDAQ. It's, up 10% so far this year after kind of a humbling February and March. Hit a new all-time high back here on the 13th of August, was setting up a bit of a pennant pattern. Looked like it was breaking to the downside, but today, rallying nicely. So, Chicken Little still chilling, how about the S&P? So, definitely still an uptrend, right? We look at the S&P, it hasn't even broken the 30-day moving average, which is, extraordinary. Since it crossed that line back here on April 25th, the 30-day moving average, it's come down and kissed it a couple of times. Once, twice, 3 times. This is the 4th time, but moving to the upside again today. So the uptrend is still intact. We're within a stone's throw of the all-time high on this index, which, the latest and greatest was August 28th. Okay. So, things are still bullish. And when we look at the VIX, it's still, at 16.8. It's still at the low end of the range of where it's been over the last year. And then if we look at the Dow, it hit a new all-time high within the last week or so. And, if we take a broader look at this, we had this big inverted head and shoulders pattern. It's broken out and is still sitting on that old resistance line, which appears to be holding as new support. Okay. So that's, a quick and dirty on where we are. Let's come now and look at, I don't have my usual stuff here. Let's start with ANET. Well, we'll start with the first letter in the alphabet. Today is not sponsored by the letter A, but it is one of the letters that we're bringing to you today. So, Arista. Now, if you're not familiar with a company, you can come to the Analyze tab, and you can see this is a tech stock. You've got 4 of these analysts that, if you want to download, you can kind of look at their reports. 2 are neutral. But if you wanted to look at some of the, what this company's about, it's based in Santa Clara. That's a place that we go on a fairly regular basis with our live events. So, they're involved in development, marketing, and sale of data-driven cloud networking solutions for AI, data center, etc. Okay, over 20 years old. And when we come down, and you can come down if you want and look at some of the basic fundamentals, but you're more likely to look at fundamentals when? You're more likely to look at fundamentals if you're looking at buying the stock or holding a longer term position. We're kind of going with the idea of we're trying to grow the account, or we're looking at a shorter term position. But we can see, the sales have gone up, year over year. Now, does that mean they're going to continue to go up? just because they've gone up year over year for the last 5 years, well, this could be the end of a run. Earnings per share has gone from 50 cents a share in 2020 to 2.23 a share. It was up 26% last year. Sales were up 15. But, when we look at this, it basically lets us know that, it's in the sector that's one of the, if not the leading sector in the rotation right now. This is a public watch list if we come to sectors. And I'm going to just compress the symbols. So if we look at the last 3 months, leading sector, communications, and followed by technology. The last month, who's been leading the pack? Well, technology, isn't at the top of the pack in the last month. We've got consumer discretionary and communications leading the pack. But when we kind of look at this chart, so let me come to the chart. It's still, uptrending, right? Right. So Chris is saying, we're more likely to look at fundamentals, and so why did I pick ANET? Well, I picked ANET because the chart, this is just as an example, because we've seen this stock, like so many other stocks, hit a bottom on the 7th, and it's crossed, and really this 30-day moving average has been holding as support. And then as many stocks have done over the last couple of weeks, they've kind of been consolidating. So we had this, either a big bull flag setting up, depending on how you want to look at it, or we had this pullback where all of a sudden, we're still seeing higher lows, but we were seeing lower highs. And then it broke out, kind of had a one-day comeback to retest, and it's been kind of holding this above this 130 line. And so, could we look at that strong stock in a strong sector, in a strong market, and say, well, could I maybe sell a short put vertical? Which is a shorter term trade. And what's the idea behind a short put vertical? Well, with a short put vertical, we are going to sell a put, which actually the definition of selling a put is saying, hey, we are willing to buy the stock at $130 a share. If you'd like us to buy 100 shares, we're happy to take it off your hands at 130. Now, right now it's trading at 137. Now, but we have a small account here. We have $32,000 in this example account. And so we really don't want a $13,000 position. Our max position size is $5,000. And so that opportunity for us isn't there to buy 100 shares of stock, or we might choose to sell the put. And in fact, we do have another example account that has $500,000 in it. And so in that one, we could sell a put. And so we might do that as an example in the other account. But here, so if we're selling a put and we aren't actually willing to buy the stock, even though by selling this put, we're indicating that we are, what we're going to do is buy a put below it. And by buying a put below it, if things go wrong, like what's our expectation? Our expectation is that the stock is going to continue to go up, or even if it consolidates and goes sideways, as long as it stays above 130, like we are happy campers, right? And that's our expectation, is that it's going to stay above this 130. But just in the highly unlikely event, and I say that a little tongue in cheek because you never know when things can go wrong, sometimes when you least expect it. If it comes down this way, we have a way out. And that way out, by buying a put, what does buying a put gives us the right to sell the stock. So if I buy this put at say 125, now the most I can lose, my theoretical max loss is $5 a strike, less what I got paid to place the trade. So if I get paid $2, I'm risking $3. Okay. And so with this one, I thought we'd look at now, and what if our expectation is that the stock is going to go up? Well, the other side of it is that we could sell a long call vertical. So let me just erase this to the trade. Okay. Okay. And we're going to compare these two. Yeah, so somebody, RG, is saying buy a long call vertical. Yeah, so we're going to compare the two. Now, what's the advantage of the short put vertical? It's a little more forgiving, because if the trade, if the stock doesn't go up, if it just goes sideways, we're still good to go, right? You know, where if we buy a long call vertical, it's more directional, depending on where our strikes are. Okay, so we'll get to that in a minute. So let's come to the trade tab. Oh, spoiler alert, Mickey D's could be on the list today. Okay, so we're at 137 and we want to come all the way down to 130. And we have a delta here of 27, but what I've also included is this probability of in the money. That's what this one is. I don't know if it'll let me, but this one here is probability of in the money is what this one is. And this is probability of touching. So at 130, we have a 30% chance of it coming down and being in the money, and almost a 60% chance of it touching. So what that means is we aren't going to get our knickers in a twist if it comes down to kiss that and go, oh, wow, like it's a losing trade. It's a losing trade. Do you guys still have me? Because somebody's asking if the feed is gone. Okay. I'm assuming we're... Okay. So I'll just say to Bill, just hit refresh. Okay. Okay. So at 130, and one of the things, if you look at our example trading plan, you know, we want to have volume on the stock of 1 million shares a day or more. We're already at 3.5 million. Okay, so when we come down to the strike, we're looking at, is the bid-ask spread tight? And by tight, we say, you know, is it less than 10%? And yeah, it's 15 cents, so that's about 5%. And then, do we have enough volume? Well, we have 1,600 contracts. So, and you know, our kind of rule of thumb is we want to have at least 20 times the number of contracts we're going to trade. Okay. And so here we go. We're going to say, well, if we were to sell a vertical, and we're at September 19th. Now, this is only 2 weeks out. So let's see if we come to the weeklies and we look at the 130. Well, we still have 65 contracts, and we have two, you know, a 15-cent bid-ask spread. So, you know, that's certainly acceptable. And the same thing here. So if we said 130 and 129, that's a 30-cent credit. Now, if we come to 128, we're getting 55 cents. How much are we risking? Well, we're risking $2 minus 55 cents. Oops. I just didn't want that to take up so much. So if I say, okay, 55 divided by 145, because our next kind of guideline is, if we're in this trade for 23 days, we want to get at least a 23% return, and we're getting potentially a 38% return. So that's a check box. So check on the volume, check on the volume on the options, check on the bid-ask spread, check on the potential return. And then we are going to put in a first trigger sequence, right click and say, hey, when we've got 80% of our max gain, now you may want to make it 90, you can make it whatever you want. But we're going to say when we've got 80% of our max gain, when this is worth about 10 cents, we want to buy it back and take our risk off the table. Now, how many of these can we do? If our max risk per trade is $500, we're risking about $150, we could do 3. Oops. Okay, so we're doing 3. I'm making this good till cancel, confirm and send. So I'm risking $444 for the opportunity to make 156. And that's kind of typical, of the way we structure our short put verticals. Now, some people might say, well, if I can't get a 1-to-1 ratio, then I'm not playing. Well, with short put verticals, often we're close to a 1-to-1 ratio, but we're not even going for 1-to-1. If we're risking one, we're saying if we're risking $1, if we can make 50 cents on that, we're going to call it good. So that's our short put vertical. And we're going to compare this to a long call vertical. Okay. Why? Because this is a class and we want to learn things. Okay, so we're going to put that in, and then we're going to come out to the other side and say, well, if we did a long call vertical, this seems to be moving to the upside. So could we bracket this and buy the 135 and maybe sell the 140, or maybe buy the 136 and sell the 138? Do we have dollar wide spreads? And what's the advantage of those? Well, let's go look. So if we said, okay, I've got volume here on these, on all of these. If I do the 136 and 138, I'm risking less per trade because it's $2 wide. Is there enough premium? So 136, 138. So here's a closer to 1-to-1 because I'm risking $1.05. We can make 95, but our goal with these is to make 50%. Now the other one is there's going to likely be more volume if we're 135, 140. So, and again, that's close to a 1-to-1. 250 would be, risking 250 to make 250. But with this one, it's got to go up past 135. Now, it may well do that, but it might not. So if we stay at the 136, 138, it only has to go up by 77 cents and then stay above that for us to have our max gain. And we might pay a little bit more in commissions. Maybe we're going to pay another, if we do 2 contracts instead of 1, or 4 contracts instead of 2, we're paying an extra $240 per contract. But if the probabilities of being successful go up, that might be a price we're willing to pay. And so if we go to 136 and 138, and then our deal here, when we're up 50%, so if we make this say 156, so it's just 105 times 1, which is the current price, times 1.5 or 150%. So that's saying 225. Okay, single order, first trigger sequence, right click, opposite order. No, that's not right. I must have put in 150. 105 times 1.5. 157. I said 156. So slay me. 156. Oh, 157. Okay, so when this gets to 157, we'll have a 50% gain, and we're saying, I know we're leaving 43 cents on the table, potentially, but it could go up to 160 or 165 and then come all the way back down, and then we won't have made anything. You know what I'm saying? So somebody in a recent survey said, geez, I hate debit spreads. I always get crushed on them. And I can absolutely feel your pain because I felt exactly the same way. But you know what? My problem was I was being greedy. I wanted every nickel I could get. And when I stopped being so darn greedy and said 50% is still an extraordinary return. It's already September in 23 days. I mean, that's fantastic. 25% would be great. So when I stopped being greedy and put in more modest expectations, my love grew. And it may be for you, and it may not, but I changed my relationship with these debit spreads or long verticals. Okay. Yeah. So we're going to compare this to the short put vertical, the SPV. Okay. Prices keep changing. Okay. So we've got those two teed up. And, filled orders. Well, we have 3 filled orders, but with ANET, it's now saying, well, we want you to pay more. And so if we wanted to just agree with that, we're just going to, kind of go in and put this in again. And we're going to compare to the short put vertical. And so sometimes we have to do that. And then sometimes we just have to be patient. Okay. But I do want to draw our attention to the fact that we are out of 3 trades that we placed. And one of them was the 2 trades, one of the pairs of trades that we placed last week was on Google. And we did 2 long call verticals, both with the same expiration, September 19th. And one was $5 wide and one was $2.50 wide. Now, if we come to the account statement and we come and we look at the GOOG, as I like to affectionately call it, and we look at our order history on these. So we bought it at $2.55, this $5 wide spread, and then we put our target in to get out at $3.90. But what happened this morning on GOOG, on the GOOG, the Google? It gapped up. It gapped up. And so, we had these short verticals, and both of them, the short strike was at 205. So we wanted it to get above 205. And the highest one was 210. One was 207.50 and the other one was 210. So here was our long call vertical, 205, 210. And so when it gapped up this morning, now this could be an example of a paper money fill because we wanted to get out at 390 on this one. On the one that was 250 wide, we wanted to get out at 202. That would have given us our 50% gain. And instead we got out at 560, which was like, that's more than 100%. Like the max gain should occur at $5. So this was perhaps a bit of a paper money fill. And then this one, the max gain should have come at 250 and it came, it showed us as being paid 305. So I'm not going to walk in detail through all of this, but the net of it is that both of these, we had a greater than max gain. We paid $1.35 and we got out at 305, which means we had a gain of 120%. And on this one, we had a gain of, well, this one was actually 126% and the other one was 100%. And so the idea of comparing and contrasting kind of got blown out of the water with this beautiful gap to the upside, but we'll take it. Yeah. So that was the first one. The other one that we ended up getting out of was Spotify. And that hit a target as well, spot. And we got out first thing this morning. Now, this is where you can see we opened here and it ran all the way up from where it opened at 693 to 711, and probably did that fairly quickly. Because when we look at the monitor tab, when did we get out of this? 7:38, so pretty early in the day. And probably when it was pretty close to the high of the day. And it hit our target and we got out. And so that's one of the nice things about putting in these targets is sometimes like you may not even be out of bed. Like right now I'm in Oregon, so that's 6:30, my time with where I'm currently staying. So some people may not be up that early. Others I know, like you guys that are trading a smaller account fans, you used to come to that class, when it was at 7:30 in the morning, 6:30 a.m. your time, 9:30 Eastern for those of you living on the East Coast. And I really admired that. You were very committed. So there's one of our 3 pairs. Okay, so let's go now and add a second new pair, and then we'll have a quick look. Well, let's look at pair number 2, which is Baker. So Baker, we did 2 things. We bought some shares. We did a buy right covered call. So here's Baker. We bought, this is the call. So we did a long call where we bought 2 calls. These expire in October, and we put in the same target as we did for the stock. And today Baker's pulling back. So you may go like, ouch, because we were up quite nicely on this, as of Friday. And then what happened? Well, the market happened. So, should we bail on this? Well, let's come and look at our buy right covered calls. Here's Baker. So we bought 100 shares of stock and we sold a covered call. Now we've only made $2 on the covered call. It hasn't gone down that much. We sold the 47 call. It's trading at 44.04, and we're up 11.50 on this position. So not a lot, but we're up a little bit. On Baker here, we're down a little bit, not a lot, $6. So let's come and look at the stock. So what do? Well, let's look at, we put it on last Wednesday, and here was our target. The previous high, basically. We sold this covered call just above the most recent high, and our target was just shy of that on the call. And then it went up nicely on Thursday and then kind of is pulling back, but it's still above the 30-day moving average. So it's still like, even though we would rather it be moving to the upside, it's still on track, and we just have to take one hand, take the other hand, sit on them and be patient. Now, if it breaks this 30-day moving average and keeps on trucking, then we may revisit it. But for right now, it's like, hey, stocks go up. They sometimes spend a few days pulling back. It's not a break of support. We wait. Okay, so that's Baker. That's on that list, and we've done the Googs. And we've done ANET. Okay. Let's come and look at MasterCard. We've got MasterCard. Now, here's I was looking for examples, and somebody at the beginning said, hey, like, why are you picking, ANET as an example? Or, why am I looking at MasterCard? Well, with MasterCard, we had, again, this series of higher highs. And then, we actually, had some not higher highs. So we had this period of consolidation. Sorry, let me get rid of that line. And then it kind of came and started to consolidate, and it's broken out and come back, and it seems to be sitting on this, old resistance. Might this be becoming new support? And it may be, and it might not hold, but what we're seeing is inverted hammer at a potential support level, inverted hammer, rose above. And then, we've got another hammer type candle today, or a candle of indecision. And you might say, well, I've done your getting started with technical analysis, Barbara, and aren't we supposed to wait for confirmation? And the answer is, with a hammer, you wait for confirmation the following day. So we got it here, and then what the market giveth, the market tooketh away. But, you know, this seems to be 1, 2, 3, 4, 5, 6 days in a row. This has been kind of cruising here. And so if we say, okay, well, I could see this continuing, this old resistance continuing to be a new support line. I recognize it's a little more aggressive entry. This, Chris, you're right, it's a kind of more of a doji type candle. Could I come below that? Like the low here on this day was 586. The low was 586. So could we sell a short put vertical with the short side being 585, which is kind of below this diagonal support line and lower than these long wicks? And, you know, could this turn out to be a losing trade? Any trade. Never think, like if you think this is a sure thing, become afraid, be very afraid. Go wash your mouth out with soap just for saying that. Yeah, because there are no sure things, you know, in the world of trading. But if we look at this and say, well, we want to come out to this 585. If we come out now, September 16th, that's not a lot of time. But what about if we look at, you know, but what's the advantage of this is that, you know, typically we want to look at that 20 to 50 day time frame, is that we're going to have more contracts here. What did I say? We were looking at 585. So, you know, we've got 200 contracts and a 40-cent bid-ask spread. But where we come here, 585, we've only got 20 contracts. And we've got a bigger bid-ask spread. Now, is it still acceptable? It's 30 cents. Is that less than 70? Yeah, so it's less than 5%. It's traded more than 1 million shares today. But the trade-off is we have less liquidity. And at 585, what's the advantage of doing this trade now instead of waiting until tomorrow, if say tomorrow it goes up dramatically, is that when you're closer to the strike you're selling, chances are the premiums are going to be higher, but the probabilities of success are lower. So this one, you know, with a probability of it being in the money is currently saying 40%. So now you have a 60% chance of being successful. So, you know, we want to get a decent premium because we're taking more risk, and we should. So here at 155 on a $5 wide spread, 155 divided by 345. Oops, call it 350. Yeah, we'll be close. So that's about a 44% return for a trade we'd be in for how long? 23 days. Yeah, so if we think, okay, that looks okay, but what if we went out to October? Could we get more? Well, let's put this trade on, and then we'll see. So we're looking at selling vertical, 150. And again, if we're just kind of sticking with that example idea, and you might, now, can we change our mind? Of course we can at any time. We could come in and say, hey, we've got, 35 cents here to expiration, and we've only been in this trade for 4 days. We were willing to be in it for 23 days. I think I'd like to take that 50 or 60% gain and call it good enough. I'm not going to wait for 80. And you can go in and change these. And in fact, we may do an example of that today. So we're going to put that in our short put vertical. And we're going to compare to a longer time frame. So what's the advantage of the shorter time frame? Well, time decay. As the stock approaches the expiration date, time happens at an accelerated rate. So if I come in and I change this to delta, gamma, theta, and vega, we have a theta of 20 on this, which means that every day this is losing 20 cents in value, which is just what we want to see. Because the quicker it loses value, the quicker we get to our goal, which is counterintuitive if you're a stock investor, right? Because you want something to go up in value. This is something we're selling high, we want to buy it back low. If we come out to the October monthlies, our time decay, our theta is 5 cents a day less. So like over the last long weekend, we would have had 15 cents if the numbers were the same. Theoretically 15 cents less decay on this strike. Okay. So let's look at what we'd get. So, and if we come back to Barb's basics with probability in the money, the probability here goes up even a little more because we have more time, and anything can happen when you have more time. We have more contracts here because this is a monthly. So that monthlies tend to be more heavily traded, so the advantage of more liquidity. But think about this. We got $1.50 for the trade we were going to be in for 23 days. And we're only getting 20 cents more. We're taking the same amount of risk, okay? And we're going to be in it for 44 days, 3 weeks more. 3 weeks more. That's like not nothing. And so because of the time decay, we don't tend to go out in the 20 to 50 day range as much to the 44-day time frame, but I wanted to compare and contrast them. And, but generally I look at that and I go, for 22 cents, yeah, not worth it. I'd rather do 2 23-day trades than one 46-day trade if I can get paid $1.50 each time. Then in total, I'm making $3 instead of $1.72. I'm not getting paid twice as much to be in it almost twice as long. This is the way some brains think. I'm not saying this is the way your brain should think, because what is the advantage of having more time is that if this trade goes against you, you've got more time to recover. And that's got some value, right? But you're not getting paid much more for the additional time you're putting your $330 at risk. So we're going to do one contract here, first trigger sequence, because we're risking over $300 and we don't want to risk much over 5 in this class. So we're going to make this 14 cents. When it's worth 14 cents, we'd like to buy it back. And that's basically 20%. Confirm and send. We're putting this in our short put vertical group. And we're going to compare to the September 23rd expiration. Okay. Okay, how are we doing for time? Oh, we're almost out of time. Dang it. Okay, so we got to compare to, and we got to look at 2. The third set that we did was different expiration dates on Cisco. And so if we come and we look at Cisco, here we did this is in our long call vertical bucket. So we did one with a September 19th and one with an October 17th. And those have pulled back a little. They're still, they haven't broken a support level, but they're still kind of percolating along. So, we will just continue to keep our eye on this. We put these on last week, moved up, pulling back. But, this is a pretty significant support level here. So we'll continue to monitor this one. Okay. And the one we didn't get to do today, so, maybe we save that for Friday, is Mickey D's. There's a Mickey D's on a corner near you, I'm sure. Yeah. And here's another diagonal resistance breakout, came back, retested, moving to the upside. So, could we compare and contrast, a short put vertical and maybe a long call vertical there? Well, we could, but we don't have time. So for today, we did 4 trades. We did 2 on ANET. So we did 2 on ANET, a short put vertical, and then a long call vertical, and I'll make sure the long call vertical fills. And then we did 2 on MasterCard. And then we had, we did a trade. Oh yeah, we did get in on ANET, Arista Networks. So we did 2 on ANET, Arista Networks. We did 2 on MasterCard, and then we reviewed the 3 trades that hit our targets. So thank you for hanging with me today. There is no survey, or at least I didn't notice one. Follow us in the Land of X. Please hit like and subscribe. And I will see you in a webcast coming up soon. Lots of great content still to come, so stick around. Take care, everyone. Bye for now.